Assalamualaikum and good day everybody. As we have as been mentioned in UKM Folio, I won't be able to make it to class for this lesson as I will be away, but we will replace it with YouTube. So the focus of the topic today is on international monetary and financial management. Here we will try to understand exchange rates and currencies in international business. We will also discuss how exchange rates are being determined, how the modern exchange rate system is being decided. We also discuss the monetary and financial systems, and more importantly, the key players in the monetary and financial systems. Also, this is very relevant with what we are experiencing right now, the global debt crisis. Do not be intimidated with the title. This is actually quite a simple topic, and all of you are actually are players in the international currency system. Some of you may have been traveled before, and if you notice the foreign currency that you are holding right now, they hold a sense of identity of their home countries. You can see in the language of the currency, the currency notes. You can also see in terms of the faces, or the artifacts featured in the notes. Usually what I do in class, in actual class, I ask the students and let them guess which currency notes do this belong to. Now this is quite easy. You can see it, Bank Indonesia, which is the one who are producing the currency note. This is from Indonesia. This could be Philippines. This could be from Vietnam. South Africa. How about this one? This is Egypt. Egypt uses pounds as their currency. So currently there are more than 150 currencies being used worldwide. Although the currency regimes are quite simplifying. If you notice, if you go to Europe, in the last few years, they are not using different currency in different countries. They are most of the countries are using euro. Some countries uses US dollar as their main currency. Even Cambodia, they are using US dollar. There are also convertible currencies, which can be easily exchanged for other currencies. Some currencies are not so easy to convert. These are called hard currencies. Hard currencies, for instance, the dollar, yen, pound, and euro, because they are universally accepted. They are more preferred in international transactions. So it is worthwhile for you to keep some of these currencies around. Some terms that are important for you to remember. Exchange rate. Exchange rate is the price of one currency in terms of another. How much do you pay for one currency in another currency value? Exchange rates can affect the fortunes of the firm in various ways. This is when the complexities of international business can be beneficial for the firm. Because the differences in exchange rates will influence the cost of input, sales performance, which market entry strategies to use, and so on. For instance, if it is cheaper to export to a host country, usually the marketer or the firm will choose export. But if it's expensive, and if the currency is not so favorable, it is better for the firm to go for other more high commitment entry strategy. A simple example is if a Malaysian company wants to borrow funds to invest in London. In 2010, let's say the company has 100,000 ringgit. The price for £1 in ringgit was 4 ringgit 79 cents. But in 2019, it's 5 ringgit and 28 cents. Now, it only makes sense for the Malaysian company to invest in London in 2010 and not 2019. So here, it will affect the timing of the entry as well. Another term is foreign exchange market. Foreign exchange are all forms of currency that are traded internationally. These include foreign currencies, bank deposits, checks, and electronic transfers. Foreign exchange market, on the other hand, is the global marketplace for selling and buying of national currencies. Also, there is a term called capital flight. This is a rapid sell-off by residents or foreigners of their holdings in a nation's currency for other assets. This is in response to domestic crisis. I will give you an example of this later. The example of capital flight is Argentina. In 2001, Argentina experienced a very heavy recession. So they experienced quite a bad economic downturn. There are a lot of factors that come into play for this situation. A few factors within context is fixed exchange rate, and also they have high amounts of borrowing and debt. That is never a good thing. And because of that, the foreigners' confidence in their economic growth has been decreasing. So what foreigners do, maybe they sell off their assets in Argentina. So if they sell their assets in Argentina, the money goes to them. And then the money goes to them and they will go out of Argentina. So they take the money with them and the money is not in Argentina. So flight, capital. So the money fly with the foreigners outside from Argentina. Even the wealthy ones from Argentina, they are fleeing off the country. So more money are flying off from the country. That is why they call it capital flight. Okay. Before we move on, let's view some recent exchange rates against the dollar. Usually, when we are talking about international currencies, we usually use US dollar to quote the other national currencies. So as you can see, this was in 2019. This is less than a year ago. In 2019, October, it took 90 euro cents for a US dollar. But now, in August, 85 cents for a US dollar. So what does that mean? The euro is strengthening against the US dollar. And in reverse, US dollar is depreciating or weakening against the euro. Okay, same case for pound. But another interesting example is rupee. Yeah, 70 rupee for a US dollar. But in 2020, 75 rupee for a US dollar. Yeah, so now US dollar is strengthening against Indian rupee. Yeah, and then Indian rupee in reverse, Indian rupee is depreciating against US dollar. So this is how you quote international exchange rates. We go back to the 4 risks of international business. Yeah, mainly we have learned about cross-cultural risk. Yeah, here we learned about differences in culture, which will affect negotiation and decision-making styles, and also ethical practices. Yeah, this can cause a lot of complexities in international business. We also discussed about country risk. So this covers political and government intervention in international business. Also, sometimes international firms will face issues such as bureaucracy and also corruption. Yeah, remember we have talked about in some countries, bribes are considered acceptable. Yeah, some countries in Africa, for example, yeah, but in some countries in Europe, bribes are not considered as acceptable. In the topic of emerging market, we discussed about commercial risk. Yeah, in terms of weak partner, operational problem, and so on. But today, we will cover the final risk in international business, which is currency risk. Yeah, the risk in currency will cover currency exposure, asset valuation, foreign taxation, and also transfer pricing. Currency risk is the potential risk of loss from fluctuating foreign exchange rates when an investor has exposure to foreign currency or in foreign currency traded investment. So in simpler words, let's say you are from China, you want to buy a factory, you have bought a factory in Malaysia. And if Malaysia's currency is weakening, yeah, is getting weak, you are currently facing a currency risk. Yeah, so there's a risk of loss no matter how much sales that you are making. Next is foreign exchange markets. Foreign exchange, yeah, as a term, yeah, they are all forms of internationally traded monies. In simpler words, it's money. Yeah, that includes foreign currencies, deposits, checks, and electronic transfers. Yeah, we have explained what is foreign exchange market just now. Yeah, also it is important to remember exchange rates are in constant flux. Flux meaning that they are always dynamic, they are always moving. Okay, if you can see the figure here, yeah, this is the historical exchange rate of Malaysia against the US dollar since 1995 to 2020. In 1995, the Malaysian ringgit was trading at 2 ringgit and 50 cents for a US dollar. By 2020, the ringgit Malaysia was trading at 4.2 ringgit per dollar. So here, in 1995 to 2020, Malaysia is experiencing an appreciation of over 68%. Yeah, so a lot of factors come into play for this situation. We will discuss it later. But this change has made the Malaysian ringgit cheaper for Americans. Yeah, but it has made the US dollar more expensive for Malaysians. Yeah, this can complicate international business, yes, but this is when international firms can use the differences, yeah, for their own benefit. Yeah, for instance, here it is better to produce in Malaysia because it is much cheaper, yeah, and sell in the US because it's more expensive there. Now observe the differences between Malaysian ringgit and Thai baht against US dollar from 1995 to the year 2020. If you can see here, this is the graph showing changes of the Malaysian ringgit, against the US dollar since 1995 to 2020. For the same range of years, you can see in this graph here the changes of Thai baht against US dollar, since 1995 to 2020. In terms of currency, in 2020, it's 4 ringgit and 185 cents for a US dollar and 31 baht for 1 US dollar. Because although of these differences, do not worry about the differences, but observe the trend. It is increasing here. The first 1995 until 1997 also. So increasing. Then around 1997 to the year 2012, also both of these countries' currencies are decreasing. But then both of them went up again, with one differences here. The end of 2017 to 2020, Malaysia observed an increase against US dollar. So it is getting more expensive to buy US dollar, for Malaysians, but it is less expensive to buy US dollar for Thai. Now, what really happened in Malaysia in these years? And what really happened in Thailand during these years? So here, as you can see here, a lot of internal factors that can influence the changes in currency. Why we change it against US dollar? We can actually change our currency against any currency. But the usual practice is to compare it against US dollar, because that is the practice. That doesn't mean that US dollar is far superior than other currencies. Okay. Another example is the Malaysian ringgit versus the dollar. Suppose last year the exchange rate was 4 ringgit and 50 cents for a US dollar. Now the rate has gone to 5 ringgit per US dollar. What is the effect of this change on Malaysians? For Malaysian firms, they will pay more for inputs from the US. So higher payment for imported inputs will mean higher costs. Higher costs will reduce profitability. To balance it out, Malaysian firms will require higher prices. At the same time, Malaysian firms can increase their exports to the US. And also they can raise their prices to the US. Because increased export to the US can lead to higher revenues. What is all this effect on Malaysian consumers? In simpler words, it will mean that most Malaysians will pay more for imported goods. So we will spend more for imported goods, but we will spend less for local items. How are exchange rates determined? In a free market, the price of any currency or the exchange rate is determined by supply and demand. Same like any stock market, or any commodity market, the greater the supply of a currency, the lower its price. The lower the supply of a currency, the higher its price. And the greater demand for a currency, the higher its price, and the lower the demand for a currency, the lower its price. But it's not black and white like this. There are a lot of factors that come into the picture when it comes to determining exchange rates. It's not fully determined by supply and demand. Yeah, because not all countries are operating in a free market. It will be determined, it will be influenced by a country's economic growth. Economic growth is the increase in value of the goods and services produced by an economy. This is measured as the annual increase in real GDP, in which the inflation rate is subtracted. If you have learned economy, this will make sense. This will also driven by entrepreneurship and innovation. If a country is highly encouraging entrepreneurship and innovation, which is always good, because it leads to creation of new products and services. Entrepreneurship does not mean a lot of entrepreneurs, a lot of businessmen. It can also mean a lot of opportunities, produced by larger firms. So meaning that these larger firms or smaller firms are creating new products, new services. They are also creating new jobs. New jobs will create more consumers. More consumers will buy more. So because of this cycle, a highly vibrant economy, is always good. Next is inflation. Inflation will definitely influence the price of a currency. Inflation refers to the increase in the prices of goods and services. Money will buy less than before. Thankfully, some countries, some of you are from China, some of you are from Malaysia and Indonesia. We have not experienced hyperinflation. A lot of countries have experienced inflation is something that is normal, in the economy. Some countries such as Argentina, Israel, Russia, and Zimbabwe, they have experienced hyperinflation for a lot of reasons. We will not go in depth into that, but if you are interested, you can look into it further. For instance, Zimbabwe especially have experienced a very bad hyperinflation, so much that it has increased they need to pay more for a US dollar. For $1 US. So much that they had to print $100 trillion currency note. So imagine if you need to pay 1,000 ringgit, for a pack of rice. So high inflation will decrease a currency's purchasing power. Now, this is what they mean by purchasing power. You will pay more for something that is supposedly have a normal type of price range. You don't want to pay 1,000 ringgit, for example, for a pack of rice. That doesn't make sense. But in some countries that are experiencing hyperinflation, that is what they are experiencing. Paying more for something that is usually not so expensive. Interest rates and inflation are positively related. Why? Because high inflation will force banks to pay high interest. Here, investors expect to be compensated for inflation-induced decline in the value of their money. Currency rates will also be affected by market psychology. Market psychology here will refer to investor behavior. There are two types of behavior: herd behavior and a momentum behavior. Herd behavior is the tendency for individuals to mimic the actions of a larger group. A momentum trader is only concerned with stock in the news. The assumption here is all buyers are rational, which means they will build all available information into asset prices. Now, this is more applicable in selling and buying of currency. Currency price will be influenced by government action. Governments will intervene to influence the value of their own currency. For example, the Chinese government will regularly intervene in the foreign exchange market to keep the RMB, RMB undervalued to help ensure exports. Here weak and strong currencies may not be as relevant. Weak currencies are good because people will import from countries with weak currencies. Here, this action will help ensure exports. Some countries really do rely on export. It will also influence by balance of payments, which is the nation's balance sheet of trade, investment, and transfer payments with the rest of the world. Trade surplus, trade deficit, and so on. It will represent the difference between the total amount of money coming into and going out of a country. Don't be intimidated by this. It just means that if you export more than importing, and then the income of your investment is more than your spending for your investment, your balance of payments will be positive. Good positive balance of payments is always encouraged. Here, balance of trade. In continuation, what we have just discussed. Trade surplus is when exports exceeding import. There are more exports than import. This can result when the exporter's currency is undervalued. Trade deficit is when imports exceed exports. The government intervention may come into play here. The government may devalue the nation's currency to correct a trade deficit. Trade deficit is something that usually governments they try to avoid. Balance of trade, on the other hand, is the difference between the value of a nation's exports and its import. Balance of trade can mean surplus or deficit. Observe the differences, how a balance of payment will influence currency. This is the balance of payments of Malaysia. From 1995 to 2020, you have seen this graph before. This is the currency between Malaysia ringgit and US dollar from 1995 to 2020. Now, I want you to notice the negative relationship between trade balance and currency. If the trade balance is decreasing, the currency will increase, meaning that if the nation's economy is not doing so well, the nation's currency, the citizen of a nation will pay more for a US dollar, than the year before. But if the nation's economy is doing well, the currency will also be stronger. Do not be afraid of this slope. The slope here meaning that you will pay less for a US dollar. This one you will pay more for a US dollar. You will always want to pay less for a foreign item. Next, we discuss the development of the modern exchange rate system. This is only some sort of like a historical lesson. The development of the modern exchange rate system happened after the Great Depression and World War II. At war's end, people seek stability in the international monetary and financial systems. Here, 44 countries signed the Bretton Woods Agreement. Why the name is Bretton Woods? This agreement is being done in Bretton Woods. Before this agreement, people buy and sell based on the value of gold. US dollar was pegged to a set value of gold. And major currencies are pegged to the dollar. Pegging means you base your value on something. So here US dollar was, the price of US dollar was based on the value of gold, and other currencies was based. I was a young child during this time and witnessed some of my friends' parents were getting laid off their jobs, which is kind of and then here I was a young adult trying to find jobs, and it was very hard because the world was experiencing a global financial crisis. And yeah, so again, you will experience a financial crisis at some point of your life. Yeah, so sometimes it will it will affect you. Sometimes it won't. It will affect you, but not directly. Sometimes it will affect you directly as well. So I would like to highlight the financial crisis in 2008. In 2008, what happened was, the year 2003 and 2004, it was the rise of the .com. And a lot of jobs went to China. Yeah, and because of that, a lot of jobs were lost. This is specifically in the US. Housing prices, they peaked in early 2006 and declined in 2007, causing a US housing bubble. Eventually, in 2008, investment bank, the Lehman Brothers, collapsed, and what happened next was the European debt crisis. So the crisis in the banking system of the European countries using the euro. So the countries using euro are affected as well. So it's not caused by one factor only. It's one factor and a few others, and interaction of other factors in the environment as well. So in reality, some countries has not really recovered from the financial crisis. One of the countries that has not fully recovered is Greece. Yeah, because of Greece's position in the euro, it has increased the tensions in Europe, because a lot of European countries, the more wealthy ones, they cover for Greece's financial crisis. Yeah, a lot of banks loan money to Greece. They expect big losses, but because the nation, the country defaults, they fail to pay many loans. And the Greek government public debt is the largest among member nations in the European Union. Yeah, but if you ask me if why don't Greece get out from the European Union, it's quite complex. This is not like Brexit. Greece is an important economy in EU, but they are not doing very well. They have not been doing well for quite a long time. Asia also experienced a financial crisis. This happened around 1997-1998. It started in Thailand. Yeah, what the countries affected were Korea, Malaysia, Indonesia, Singapore, and the Philippines. This was when the rise of the tiger economy. Tiger economy includes South Korea, Singapore. Yeah, so these countries were thriving, but after the financial crisis, they went down for a while. So the currencies lost about 70% of their value. So it started in Thailand, if I'm not mistaken. Again, a lot of factors were influential. At one point, it happened. Yeah. Now, what we are experiencing also a lot of job loss. Yeah, a lot of companies are closing, and a lot of major companies actually closing their business. So that looks a lot like an economic recession. But this crisis is different because the whole world is actually experiencing the same thing. So what we are seeing right now is plant closures, facility closures. So supply lines are drying up. What we are really seeing right now is unemployment. And when you are graduating, yeah, in the next few months or in 1 or 2 years, your job environment will look very different then your brother or sister, then your parents. So what does this mean? For managers, managers should be aware of the monetary changes that affect firms' performance. As consumers, also be aware of the changes, and as individuals, I won't say be aware, but take into account the changes that are happening in the world, because they are affecting everybody. So to recap, what we have discussed today is currency risk. There are several factors influencing the price of a currency, which is supply and demand, market psychology, government intervention, and so on. We also discussed the relationship between trade balance and currency rates. We also have discussed the players of international monetary system. This includes different levels, the firm level, national level, and also international level. So this includes the firm, commercial banks, the stock market, commodity markets, bond markets, regulated by the central banks, and this is supported by the IMF, Banks of International Settlement, and also World Bank. We have now reached the end of the main risk in international business. We will focus more, the next few lessons, we will focus more on a strategy to enter the international market. So this will be included in your quiz 3. Quiz 3 is about understanding emerging markets and also international monetary and financial environment. Because you have been doing quizzes quite a lot, quiz 3 will be conducted in 17 August, 9 p.m. to 10 p.m. Okay, again, please revise the contents. As usual, the international business content is quite a lot, but if you notice, the themes are recurring. They are repeating within different contexts. So you have to remember and have to understand the different concepts and try to apply them in different situations and different countries. Okay, till then, I will see you in our next lesson. Thank you very much. I hope to see you soon. I end this lesson with Assalamualaikum, and also have a good day, everybody. Thank you very much. Again, the US dollar was pegged, was based on the value of gold, and the other major currencies were based on the price of the dollar. So this is what is decided in Bretton Woods. For nearly 30 years, the system kept the exchange rates of major currencies at a fixed level. Bretton Woods is actually a place of a name. Anyway, it was being dissolved in 1971. As the world economy was evolving, and it was not so feasible to maintain a fixed exchange rate based on gold standard. But Bretton Woods has established the concept of international monetary cooperation. This is especially aimed to minimize currency risk, because minimizing currency risk can actually be done if countries work together. Bretton Woods also has established the International Monetary Fund. This is an agency that promotes exchange rate stability. This agency will also monitor exchange rate system and providing funding for developing economies. Also, the Bretton Woods Agreement also has established the World Bank, which is an agency that provides loans and technical assistance to fight global poverty around the world. So a lot of positive outcomes from Bretton Woods. The concept of international monetary cooperation and bodies such as IMF and also World Bank. IMF especially, they promote exchange rate stability, and World Bank aiming to fight global poverty around the world. just some pictures of Bretton Woods. This is a picture of Bretton Woods around 1940s, 1950s. Yeah, this is how it currently looks like. The exchange rate system today, yeah, usually they float according to market forces. Yeah. Now, in international exchange rate, there are two types of a system: floating and also pegging. Floating means the currency rate will be determined by supply and demand. So they float. If the floating basically, yeah, essentially based on supply and demand. So they float like this paper boat. Yeah, some currencies, they are being pegged. Pegging means the thing that you use to clip your clothes, yeah, against the wind when you are drying your clothes after laundry. That is pegging. So even if the wind is blowing very hard, your clothes will still stay on the line. So this is the principle of pegging. Floating will mean that the currency will be more dynamic. Pegging will mean that the currency will stay in place. Yeah, the risk of floating is you really depend on market supply and demand. Yeah, if it's good, it's good, and if it's bad, it's bad. If it's good, you will gain the benefits, yeah, and very profitable benefits. But if it's bad, it's quite risky. Pegging, on the other hand, meaning that you aim for stability. Yeah, so you will miss out on the opportunities of that is offered by free market, but you protect yourself from here. Yourself meaning the nation. The nation will protect itself from the risk of free market. Yeah. Now we've gotten that out of our hands. So today, advanced economic currencies, yeah, they float according to market forces. Yeah, major currencies such as Canadian dollars, Japanese yen, yeah, and so on, they are determined by supply and demand. But most developing and emerging economies, yeah, remember which are the emerging economies, emerging markets that we have learned last few days. Yeah, nations such as Brazil, Russia, yeah, they are emerging markets. They use a fixed exchange rate system. They peg, yeah, the value to another basket of currencies. Usually they peg their value to the price of US dollar. Some countries, they use pegging as a system. For example, most Caribbean island countries, yeah, they peg to the US dollar because their main source of income, yeah, is based on tourism. Yeah, tourism here, they are being paid in dollars. Next, we discuss the international monetary and financial system. The international monetary system is the institutional framework, rules, and procedures by which national currencies are exchanged for one another. The global financial system, on the other hand, is the collection of financial institutions that facilitate and regulate the flows of investment and capital funds worldwide. It includes the national and international banking system, the international bond market, and the national stock markets. Here, the examples are European Central Bank or the International Monetary Fund. There is also a growing integration of financial and monetary global activity. They are being attributed to the factors are worldwide evolution of monetary and financial regulations, yeah, the emergence of new technologies and payment systems in global finance. Those who are in finance, maybe you can explain this to your friends. Yeah, the rise of fintech, the rise of cryptocurrency, how it influences how we pay. Yeah. Also increase regional and global interdependence of financial markets and the growth of a single currency system. For example, Euro. all of the changes in the international monetary market, they are being influenced by the key participants and relationships in the global monetary and financial systems. There are several levels that you may need to remember. First is the players in the firm level. These are the firms, the multinational companies, the small and medium companies. They are also regulated by the national infrastructure level. This can include the national stock exchange, the bond market, and also the commercial banks. Next is the national government level. National government level only has one institution, which is the central bank. Next, we have international organization level. Three main organizations here: the International Monetary Fund, Bank for International Settlements, and also the World Bank. In the firm level, of course, the players are the firms. They are the ones who are conducting international transactions. They require firms to deal with huge sums of foreign exchange. Companies like BMW, they build factories in their markets. What does this mean? If the market is in the US, there is a factory in the US. If there's a market, if they are targeting the China market, there is a BMW factory in China. So this will reduce foreign exchange exposure, the currency risk. They are also closer to the customers and also shorten supply chain. This is how some companies manage the changes in currency. There is also the national infrastructure level. How do they influence foreign exchange? Think about the export-import, performance of the firm, stock price, and also consumers' confidence. So all of this, in interaction, they influence currency prices and also indirectly foreign exchange. In the national infrastructure level, commercial banks, they play an important role to lend money to finance business activity. They also play a role in the nation's money supplies and also exchange foreign currencies. So these are the commercial banks in Malaysia, which are the players in the national infrastructure level. This will influence especially firms, I would say small and medium firms, because they will require some, if they need to do new projects, they will require some amount of money. They need to make some loan, they need to borrow some amount from the bank. If the bank is not refuse that request, the firm won't be able to pursue their project. So this in turn will influence the nation's economic stability. Next, we have the national government level, which are the central banks. Central banks are important because they regulate money supply, they also issue currency, and also manage exchange rates, and they control national reserve. The goal here is to keep price inflation low. They are not able to give funding for small businesses, but these are the things that they can do. They regulate the players in the national infrastructure level. Here, you are more powerful than here. In the international organization level, there are banks for international settlements, which supervise central bank monetary policy and other activities. There is also the International Monetary Fund. The focus here is for economic performance. IMF also provide framework. They determine code of behavior for the international monetary system. They also promote international monetary cooperation and also encourage exchange rate stability. In special conditions, they offer special drawing rights. This is to supplement central banks if they they will need some kind of support. Yeah. Special drawing rights, they have their own currency. Yeah. If you are interested, this is under IMF. Yeah, you can look into this further. Yeah. For your level, we do not really investigate this so much. Yeah. Next we have the World Bank. Yeah, the focus is to reduce world poverty. They have several other bodies under them, yeah, including the United Nations. Yeah, so here please remember the firm, which includes the multinational company, the local small and medium businesses. Sometimes they will require money from the commercial banks. Yeah, and then the commercial banks and also their activities are determined by national stock exchange and bond markets. So all these are regulated, yeah, in the national level through the central banks. Many central banks around the world, yeah, are being regulated by the IMF, Bank for International Settlements, and also World Bank. Remember, these bodies do not own the central bank, but instead they provide support for the central banks around the world. As we are in this topic, it is important for us to discuss the global financial crisis. Yeah, if you can see here, every 5 years we will experience global financial crisis. Yeah, it depends on the geographic location, and the financial crisis also will differ in terms of the size and also how serious it is. In 2008, a major crisis emerged in the global financial and monetary systems. Yeah, initially it started in the US. Yeah, this happens when the investors lost confidence in the value of a home mortgage. So what happened was banks, lenders, insurance companies became volatile, meaning that they are sensitive to changes, and stock markets crashed worldwide. Because of a lot of economies depend on the US, many national economies sank into recession. The world experienced a sharp decline in consumer wealth, economic activity, and international trade. I personally experienced a lot of my, I was really a very young child around 1997 and 98.